Hi, good morning, everyone. And thank you for joining us for Phillip Securities Research Morning Call for the 13th of June, 2022. So for some reason, you guys have asked, a lot of you guys have asked about the timings of this webinar. For some reason, Zoom does not allow us to send out our invites in 15-minute blocks. Instead, they only allow us to send it out in 30-minute blocks. That's why our only options are 11 a.m. or 11:30 a.m. On the other hand, we've also included the actual webinar start time in the description of the when you sign up for the webinars, which is 11:15. So for today, we've got stock counter updates from Pan United Corporation and Top Glove. For Top Glove, it's a Phillip on the ground update. In terms of macro and sector outlooks, we have the FAANGM Monthly for the month of May, as well as the Singapore Banking Monthly. So I'll begin with the FAANGM Monthly for May, with our title Still Attractive Despite Economic Uncertainty. So for our FAANGM performance, or rather overall market performance, the FAANGM declined 3.1%, while the S&P was flat. The Nasdaq dropped 1.7%. In terms of outperformers, Netflix outperformed, gaining 3.7%. This was largely due to a very strong showing from its new release of Stranger Things. Apple was the main underperformer, losing 5.6%, and this was mainly due to news that came out for Apple that its production for iPhone units were going to be relatively flat for this year compared to last year. So the main news for Apple, the company is actually seeing a modest reacceleration in App Store spending and downloads. So halfway through the third quarter of its fiscal year 2022, Apple's global App Store revenue has already risen 7% year on year, with total downloads on iPhones and iPads up about 5% year on year. So just for some comparison, App Store revenue grew only about 6% year on year in the previous quarter. So like I just mentioned, Apple's actually, or rather, there's going to be some iPhone production is expected to remain flat, and there's also increasing labor costs. So there's a report that has come out that Apple is actually looking to keep its iPhone production flat for the year, which puts it at roughly 220 million units, indicating that there could be some headwinds in the overall consumer electronics environment. At the same time, the company is also raising its pay for store and corporate employees, citing a tighter labor market as reasons for this. So overall for Apple, some good news in its reacceleration of higher margin App Store revenues, and a little bit of negative news for in terms of waning consumer demand for its products and a tighter labor market. In terms of Amazon, there wasn't really that much news for it, except the stock was down to its 52-week lows in the middle of May. Several reasons for this were rising inflation, tougher comparisons versus a pandemic-inflated 2021, and weak earnings across from other retailers or other online retailers that sent Amazon's stock down along with them. At the same time, investor sentiment continues to be quite negative over worries of slowing consumer demand. So for Microsoft, Microsoft actually marginally reduced its fourth quarter 2022 outlook, and this was mainly due to unfavorable foreign currency movements, which is weighing on its outlook. So management now anticipates a total revenue to be in the range of 51.9 to 52.7 billion US dollars, and this was reduced down slightly from 52.4 to 53.2 billion. So a very slight, a very marginal decrease in revenue. Additionally, Microsoft now also expects diluted earnings per share to be in a range of $2.24 to $2.32, and that is down from $2.28 to $2.35. A big reason for this is that Microsoft generates more than 50% of its revenue from international markets. So for Microsoft, our investment thesis remains unchanged since these dynamics are largely beyond Microsoft's control. Moving on to the next few counters. So for Meta, they officially changed their ticker from FB to Meta on the 9th of June. at the same time, in May, they started cutting their spending in their reality lab segment. And this is in line with its expense guidance that they mentioned in their first quarter 2022 earnings call. It has also been slowing down hiring for reality lab segment. So these cost-cutting measures, we think, are not really company-specific, but seem to be affecting most companies across the tech sector, with slowing growth outlook as the key reasons, or rather the key reason for this. There's also a new Senate bill that could force Meta to break up its business. So lawmakers in the US have introduced a new bipartisan bill in the Senate and have named it the Competition and Transparency in Digital Advertising Act. So this act mainly aims at to target conflicts of interest in ad tech and would prevent companies that process more than $20 billion a year in ad revenue from taking part in more than one section or one area of the digital ad ecosystem. So this could spell some trouble for digital ad dominators like Alphabet and Meta, who could be forced to divest parts of its business if the bill is passed. So Netflix is also laying off about 150 employees due to cost cutting. This represents about 1.5% of its total workforce. And this is in line with what they mentioned during their earnings call, their first quarter 2022 earnings call as well. And two of them, or rather the main reasons for this, is slowing revenue growth, and also the company's plan to maintain steady margins as a reason for its pullback in spending. So at the same time, Netflix's new their new season of Stranger Things actually smashed quite a lot of records. They smashed viewership records over the long Memorial Day weekend in the US, topping the charts with about 287 million hours viewed in just 3 days. The previous record for an English language series was set by Bridgerton Season 2, which streamed about 193 million hours in its first weekend. So for Netflix, its plans to pull back on spending is quite expected, especially as the company tries to maintain its profitability moving forward. However, the continued success of Netflix original productions reiterates the company's ability to generate quality content for its subscribers. And lastly, for Alphabet, Alphabet's cloud segment, Google Cloud, is actually partnering with AMD, Advanced Micro Devices, to aid in supporting their chip design workloads, as well as enhancing AMD's data centers. So as part of the deal, AMD will leverage on Google Cloud's storage, networking, and machine learning capabilities to improve its own hybrid and multi-cloud strategies for its chip design requirements. So we think that the partnership with AMD continues to enhance Google Cloud's credibility and effectiveness in providing quality cloud solutions for enterprises, and is one of the main reasons why we expect its cloud segment to continue its high growth moving forward. So just to sum it up, we remain overweight on the FAANGMs. Valuations remain attractive right now. At the end of May, it was at 29 times forward PE, compared to their average of 31 times forward PE. Since then, it's dropped a little bit to, I believe, closer to 25 times forward PE. Our preferred picks are still Google and Microsoft, or Alphabet and Microsoft. We think that increasing corporate demand for Alphabet's high margin cloud services should continue to push revenue growth forward. And growth for Microsoft is still expected to be very strong, even as it reduces guidance marginally. So with that, I'll have my time on to Glenn for our Singapore Banking Monthly. Thank you.
Thanks, John. So for the Banking Monthly, we'll start off with the interest rates. So the interest rates continued to increase in May, and the 3-month SOR was up 41 basis points month-on-month to 1.47%, while the 3-month SIBOR was up 27 basis points month-on-month to 1.21%. The 3-month SOR is 93 basis points higher than its first quarter average of 0.54%, and has improved by 120 basis points year-on-year. The 3-month SIBOR is 68 basis points higher than its first quarter average of 0.53%, and has improved by 77 basis points year-on-year. So in the next slide, We have two other points of interest. The first being Malaysia's central bank, the Bank Negara Malaysia, announced the 5 digital banking license winners. And they are Grab Holdings, C Group, Malaysian mobile carrier Asiatex, FinTech unit Boost Holdings, Aeon Financial Service, and KAF Investment Bank. The Bank Negara has kept the digital bank's assets at 3 billion ringgit or 0.94 billion Sing dollars during the foundation phase, which could be mid-2026 to mid-2029. And this means that the total digital bank balance sheets will be less than 1% of the Malaysian's banking system. And the digital banks are hence more likely to focus on less capital-intensive areas like payments and remittances, distribution of third-party investment, and insurance products. The second point to highlight is that the MAS has imposed an additional capital requirement of about 330 million Sing dollars on OCBC for its deficiencies in responding to a wave of spoofed SMS phishing scams in December 2021. This additional penalty will impact OCBC's CET1 ratio by 0.21%, and which would mean OCBC's CET1 ratio would now be 14.99%. Nonetheless, this will not affect the bank too much, as it still has a healthy CET1 ratio at 14.99%, which is still higher than DBS at 14% and UOB at 13.1%. Now moving on to the next slide. Hong Kong's domestic loans grew by 1.73% year-on-year, but fell 0.69% month-on-month in April. The month-on-month dip in loans growth for April was the lowest since December 2021, and the year-on-year loans growth declined by 51 basis points from March loans growth of 2.24%. For Malaysia, their domestic loans growth was 4.98% year-on-year and 0.41% month-on-month in April. The increase year-on-year in April was the highest since March 2019, and an increase of 42 basis points from March loans growth of 4.56%, while the increase month-on-month was a decline of 17 basis points from March loans growth of 0.58%. Now moving on. So the preliminary SDAV for May dipped 6% year-on-year to 1,487 million as community COVID-19 cases begin to fall gradually. The VIX averaged 29.3 in May, up from 24.4 in the previous month. The top 5 equity index futures turnover saw an increase of 20.5% year-on-year in May to 15.56 million contracts, mainly due to the higher trading volumes of its FTSE China A50 index futures and the Nifty 50 index futures. Notably, the MSCI Singapore index futures increased 20.5% month-on-month to 1.28 million, and the Nikkei 225 index futures increased 25.2% month-on-month to 1.15 million, while the FTSE China A50 index futures fell 5.7% month-on-month to 8.62 million. Now for my last slide. We maintain overweight and we remain positive on the banks. The bank dividend yields are attractive with upside surprise due to excess capital ratios. The improving economic conditions and rising interest rates remain tailwinds for the banking sector. SGX is also another beneficiary of the higher interest rates. So that's all I have for the banking sector. I'll now hand it over to Terence.
Okay, thanks, Glenn. So for Pan United, the title of our report is Construction Recovery Gaining Pace, and that's really the stance that we have on the construction sector. In our next slide, for the first quarter 22 summary, there was no results update from PanU as they have moved to a half-yearly reporting. However, according to the Building and Construction Authority, BCA, demand for ready-mix concrete or RMC for the first 3 months of 2022 was 5% higher than for the same period in 2021. In other data, construction recovery we continue to remain on track with progress payments. Progress payments is when they complete the project, and then they bill the developers. Okay, build for 2021 was 32.5% higher than 2020, and this is for the full year 2021. Whereas for the first 3 months of 2022, it continues to be about a third higher than 2021, at 33.2%. So you can see this on the left hand side of the page. You can see demand for RMC concrete is a little bit, the increase is a little bit subtle, but what we can see is that we see a collapse obviously due to COVID, and then now is already above pre-COVID level already for RMC, for the ready mixed concrete, and that's our main thesis for Pan United, that you're really catching it at the recovery phase, because it is collapsed, right? So you're really catching it when it's recovering, and it's not just recovering to pre-pandemic levels, it's recovering to try to close the gap between the shutdown that it had. So they're trying to rush all the outstanding projects and also the new projects. That's why the demand is so strong, especially for 2022. Whereas the table at the bottom, rather, you can see for the construction contracts awarded, this higher than the progress payments, and that generally is a good sign, because it tells you that there's more, the amount for the construction contracts is higher than the progress payments, which means that in the months ahead, or the years ahead, as they start to fulfill these contracts, this will translate to additional revenue for the company. Credit situation in the construction industry is also currently stable. The government is closely monitoring this. They are also closely monitoring this, and they are helping the sector try to tide through this difficult time. Nobody wants a collapse, so they making sure that they are trying to make sure that the situation is stable for the whole entire ecosystem. Yeah, next slide. In terms of some of the positives. Yep, thanks. Construction recovery was ahead of our expectations. The recovery was, we didn't expect it to be so fast, but they managed to settle some of the outstanding issues, and so we upgrade our forecast of the total RMC volume to 13.5 million cubic meters for 2022 versus our 12.8 million previously forecasted. Some of the manpower shortage that was bugging them in the last 2 years has also largely been resolved. According to the Ministry of Manpower, work permit holders in these sectors now account for 90% of pre-pandemic levels. So they have not much issue already with the manpower. And we also expect the strong operating results in the first half to drive the group into a net cash position earlier than our initial forecast of third quarter of 2022. But some of the things that we are naturally concerned about is the supply chain disruptions and the volatile freight costs, which will squeeze margins. You can see for the April 22 ASPs, April 22, some of you may be wondering why April 22, because that's the latest one. The average selling prices are 8.4% higher than December 21. So in just about 4 months, the prices of RMC already surged 8.4%, and this is a result of higher cost of raw materials, and so these raw materials are like sand, aggregate, and also the freight cost. So average daily charter hire of the Supramax and Handy size, for perspective, has risen from an average of $28,650 US dollars per day in 2021 to US $31,150 per day. So this is because of the higher oil prices, which we are all aware. So in our last slide, in terms of our outlook and recommendation for the industry, construction sector has seen a faster pace of recovery in the first quarter of 2022, which was way ahead of our expectation. We expect the escalation of activity to continue for the rest of 2022. For perspective, HDB has already announced that it plans to launch up to 23,000 flats per year in 2022 and 2023. This is to meet the rising demand for homes in Singapore, and represents a significant increase of 35% from the 17,000 flats launched in 2021. Again, for perspective, 2021 was already slightly elevated from the 14 to 15,000 flats that they used to launch before 2019. The Changi Airport Terminal 5 project is also expected to be resumed after being put on hold. So for perspective, the Changi Airport Terminal 5 project is very huge. larger than Terminal 1 to Terminal 4 combined. So the minister already announced that they will resume construction of Terminal 5 in the next 2 years. And this we expect will support the tailwinds in the construction sector. In terms of our recommendation, we continue to maintain a buy recommendation on PANGM with a higher target price of 68 cents from 46 cents previously. We upgrade our earnings for 22 and 23 by 35% and 26% on account of the higher demand for RMC brought about by the construction recovery. Our target price is based on 12 times financial year 22 PE. And so this 12 times is actually a 20% discount to its 10-year historical PE, because we acknowledge there's still some uncertainty in the business environment. That's all from me for PANGM. I'll now hand over the time to Vivian.
Thanks, Terence. For the next counter, and also our last counter for today, would be on Top Glove Corporation. And this is a Phillip on the ground for their 3Q22 results. So firstly, for the results, they recorded a revenue of 1.5 billion ringgit. This is down from 4.2 billion on a year-on-year basis, while PATMI fell about 99% to 15.3 million. So this is still very much mainly due to the falling glove prices. However, if we compare quarter on quarter, we are seeing a lower percentage drop in the prices. So it's kind of like entering the normalization trend is continuing. So for example, for nitrile gloves, which make up about 40% of the total production volume, the prices dropped 15% quarter on quarter. This compares to a 26% drop in 2Q22 as compared to 1Q22. On the demand supply situation, it still is very much in imbalance. So the industry remains oversupplied, but there has been some supply reduction in the recent 5 to 6 months as some of the smaller factories are closing down, while others have been reducing capacity by around 50%. And for Top Glove, they are also deferring their capacity expansion plans. On questions about why it is taking so long for supply to normalize, management shared that some of the Chinese players actually doubled their capacity during the peak of the COVID. And basically, the increase was too much for the industry in general. So moving on to the demand, it still remains quite strong. Demand was up 6% quarter on quarter. If you refer to the chart on the top right, you can see that sales volume basically increased across all geographies except for Eastern Europe. And they also mentioned that they are expecting more recovery in demand due to the continued reopening across the world. So there is expected to be more demand from the food industry, restaurants, hotels, and airports. And on sales to the US, they mentioned that they are definitely more competitive than the Chinese players. As if you are a US company and you source from China, then you have to pay tariffs of around 25 to 28%. This is for non-medical gloves, where it could be around 3 to 4% if you source from some of the Southeast Asian countries. So lastly, for the outlook, prices are stabilizing as we have seen, but costs still remain elevated due to the current operating environment. But as mentioned, management still remains positive on the expectations of demand picking up as more countries open up, and also on the normalization of the supply-demand or balancing of the supply-demand situation. Yep, so that's all for Top Glove. I guess we can move on to the...
I think I'll take one of the questions about the banks. So bank shares have been dropping lately. Is it a good time to start buying the dip? Yeah, it has dropped lately. Okay, so I can't say whether now is a good time to start buying, but for the outlook wise, there are a few things that we can look forward to. The first one, of course, being the upside from the higher rates. So the interest rates should definitely improve the bank's bottom line by raising their net interest income and their NIM, and this will raise their PATMI. So that's definitely not going to go away. The second one would be that the banks are quite confident that their loans growth would be stable at mid to high single digit. And the third point being that their credit costs would also remain lower than during the COVID times. And DBS is the only one that is saying that it will be lower than pre-COVID. So going to this, I would think that the bank shares would definitely perform, the bank's performance would definitely be quite stable moving into the second quarter and the rest of 2022. Oh, there's also one more question. I think I answered it by typing it out. It's the TP for the three banks. So for DBS, it will be $41.60. OCBC is $14.22. And UOB would be $35.70. Okay, so there's one more second bank question that came in. How do we reconcile that the shares prices of local banks are falling and institutions are selling for weeks, yet analysts are still bullish on the sector? And what are the signs and factors we should look out for to signal that the share price of local banks will start to turn around? I would say the few signs, of course, would be their performance. So, second quarter results are coming out soon. So, there's one sign. And I guess, yeah, just seeing how well they do and if they are true to their word and their guidance that their loan growth is maintaining and that the effects from the interest rates hikes are translating into their NIMs, which would increase their net interest income. Okay, so I hope I've answered the questions. Yeah, that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
I can take a couple of questions regarding the US market. So there's a question here, Amazon, why does TP does not reflect or TP of 3,130 still stands? Yeah, apologies for that. This is pre-split, so if you take the split of 20-1, the TP should be, the target price should be about 156.50, which is about, I guess, 50% upside from where it is right now. There's another question here I'll try to take. What sector industry is a good buy to be on the forefront of recession for protection cover risk? Please give some companies for reference. I guess for the US market, usually you try to look at the companies in the consumer staples, utilities, even healthcare as defensive sectors. And so for each of them, I guess for consumer staples, you look at companies like Costco, or like Procter & Gamble, these kind of places that aren't severely affected by recessions because they offer or they sell a lot of everyday products that people still have to buy, necessities that people have to buy. For healthcare, you can look at United Healthcare as a company that you could purchase in the healthcare sector. I guess for utilities, maybe like NextEra Energy, these kind of American energy provider. I think these are generally your energy providers still should be doing quite okay. Yeah, I think that's all for me for right now. I'll have my time now on to my colleagues. Thank you.
Yeah, I think I'll jump in to take the next few questions. The terms of merger between Keppel and Sembcorp Marine are unfair, says a top 20 Sembcorp Marine shareholder. What is your take? Yeah, so I think for us, I think a bit of historical context will probably help. For Keppel and Sem Marine, they have actually explored merger even in the 20 years ago. They have explored merger in year 2000. the two shipyards came together and they explored whether a merger back then would make sense for the two. So they spoke, but because the climate then was very, very good, the oil prices was rising at a steady clip, and their businesses were doing well. Both were profitable and landing good, securing good orders. So none of them saw an imperative to come together to merge their entities. But during the oil price collapse in 2014, 15, and 16, the talk then emerged between the two. So some historical background to try to bring their two entities together again, because the climate, the backdrop now is less favorable for both entities, and then a merger makes sense. So let's look at things in that perspective. It's not easy for the two entities to come together. They've over the years, they encountered a lot of difficulties to try to bring these two entities together. So there are a lot of terms that they came up with, and I think what we have to appreciate the challenge in trying to devise the best deal for not just Keppel Corp but also Sembcorp Marine. Based on the current circumstances in the oil market, obviously as we covered in the last 9 to 12 months, but the backdrop still remains a little bit more challenging for them. There are still unutilized rigs. Cash flow continues to be a little bit more challenging going forward. So it may not be the best deal that everybody will want, but I think based on the circumstances, is probably the best deal for everybody, because you have to consider the revenue synergies that these two entities will enjoy when they are a larger entity. There are Korean shipyards and the Chinese shipyards, which are far larger than the Keppel and Sam Marine shipyards, and they're actually competing against each other. So when you compete against each other in a challenging market, it doesn't really make sense. So the first point I would make is that it's very challenging to get to this stage, especially coming together when you're merging two very large entities together. There's a great deal of challenge. The second point I would make is the revenue synergies of these two shipyards combining will accrue to shareholders at a later stage. And then the third point, obviously, is the cost synergies that will accrue to shareholders at this stage. I think it's easier to make a point now because the oil prices is rising, so people feel like, oh, maybe we could have gotten a better deal. But let's not forget what has happened in the last couple of years when the oil market is challenging, and we can't read into the future, right? In terms of how the oil market will continue to perform. So I think given the totality of the circumstances, this is probably the best deal that the two entities have put on the table. If you want something better, then you something has to give also. Then there'll be challenges on the Keppel side also. So it's difficult to come to like the best deal for everybody. I hope I answered your question. If I wasn't clear, please just follow up below. I'll go to the next question. Paul is currently on leave, so there are some questions that for Paul, and then we won't be able to answer today. But if you need the answer from Paul, maybe you can email him. Hi, if we compare BRC Asia and Pan United, which counter is a better pick for price upside for construction sector play? There are a few questions, so maybe I take them by rolling order. Which counter is a better pick for price upside for construction sector play? In terms of the sector, we prefer BRC Asia. BRC Asia, we have coverage for both counters. BRC Asia, we believe is a stronger play because BRC Asia, they have a much stronger market share in the market. They have about 2/3 of the steel market share. For PanU is 40%. So for BRC Asia, in terms of valuations and in terms of market share, they are a better pick for in our construction sector. Both are still poised to see both are still poised to see a recovery. I think they're at the early stage of recovery for both counters, and so both would be a good pick. But if you have to pick one, it would be BRC. Are both companies affected by higher input or raw material costs, higher interest rates, and are they able to pass the increased cost to their customers? Yes, and yes. So both companies face the same kind of higher input and raw materials costs. This let's be clear, this higher raw materials cost affects the entire industry. So both companies are naturally affected by all these things, including higher interest rates and higher raw material costs. But for BRC Asia, their interest rates are very low because most of it is letters of credit, receivables contracts. So they don't hold a lot of debt. So in terms of interest rates, very, very marginal. In fact, the all-in interest rates for BRC probably sub 2%. And for Pan United, interest rates is lesser a concern because they're going to swing to net cash. As it is, they are already very close to net cash position, but we expect that by the end of this quarter, which is a couple of weeks' time, they will swing to net cash really. Your last question, are they able to pass the increased cost to the customers? Yeah, definitely yes, because both BRC Asia and Pan United, their margins are actually they are like traders. So they make a certain margin. They cannot absorb all the margins from there. If they absorb, then they swing to a loss really. So most of the new contracts that are being rolled out we take the HDB contracts for instance. So the HDB contracts today, they come with two types of pricing. The first type of is a fixed cost component, and then they have the variable cost component. The variable cost component is to protect players like BRC and PanU. So when say there's a surge in the prices for cement or reinforced steel, then BRC and Pan United, for HDB, they can then pass this cost on to HDB because of the variable cost component in the contract. So HDB recognizes this. They know that things have been very challenging, and so they allow that kind of cost pass through to the customer, in this case HDB or government contracts as well. Yep. So let me know if I didn't answer your question or you have a follow-up question. Just feel free to put it in. There's one question. I have SPH shares. Please help me understand what will happen and if I will need to make a decision, including your insight, please. Thanks. I think the issue, the SPH shares are already concluded already. You may want to check with your financial advisor or your CDP, check your CDP or the custodian account where these shares are held in, because they really it's likely that you have exercised either of the two options. The default option is from Joe. The default option is cash plus a combination of cash and SPH REIT, and then or you could have opted for a cash all cash offer. But this was in last month. They really closed the thing last month, so you may want to check with your custodian in your custodian account. Next question, Terence, can you share what is Pan United competition like, and who are their main competitors? Do they have presence out of Singapore? Yeah, so the most of Pan United's competitors are actually non-listed companies, so it's a bit difficult to get a read on them. They have other smaller players, but most of them don't hold a significant market share because Pan United is 40% market share. So some of them a little bit more fragmented when we look at the market. Most of them about 5 to 8%. So they are really very small. Do they have any presence out of Singapore? No, not really. Yeah, their main basis, the main concentration is in Singapore. But thanks for the question. Yeah, so that's some Singtel ones. Those are for Paul, but he's on leave today. Any pointers for sets? Yes, it has been falling. Yeah, so for sets, it's facing the same kind of issues with SIA Engineering and most of the aviation companies like SIA Engineering and SIA. What happened is that now they find themselves at the recovery phase of the cycle, and at the recovery phase of the cycle, demand is picking up very quickly. In fact, when the ministry minister just announced recently that for the first week of June, the aviation numbers is already at 50% of pre-pandemic level. So that's a very strong recovery. We're already halfway there, and they expect that for the rest of June, we will keep at a 50% mark. So for sets, they are and the rest of the aviation companies, they are really trying to capture this upswing in the cycle. So what is happening is that they're actually hiring in advance for a lot of those workers that were furloughed or retrenched in during the pandemic. They're trying to hire them back now, and it takes time for them to get back into doing the job. According to management, that takes about 3 months to 6 months before, depending on the role, before they can become competent in their role. So a lot of this hiring and this training is now going to weigh on their margins until they hit peak capacity. A lot of these costs are incurred up front, and that's the reason why sets was actually, we see a strong sell-off in their recent results because of that strong the strong decline in their margins, because they're actually investing a lot in the near term. But I think the long-term view for sets remains on track. They continue to hire in anticipation of the recovery, and we anticipate that if things continue like at this current phase, they will be able to turn profitable maybe before 2023 even. SPH REIT, should I sell to Cascada? Again, I think this is from an anonymous attendee. Again, I think the thing is already this is yeah, the SPH REIT is when some background. Sorry, I think I misunderstood the question. For SPH REIT, under the SGX chain offer, they had to actually make a compulsory chain offer for SPH REIT because of their acquisition of SPH. So it was never their intention to delist or acquire SPH REIT, and that's why the price, which has to be the highest of the VWAP, is actually lower than the market price. So you don't have to sell if you don't want to. Of course, you take into account whether your own financial needs, but since it's lower than the market, you don't have to sell. One more question for me. How different is BRC from Yongnam and Lee Metal? Yongnam, they do a little bit of construction, so they're focused on construction. BRC is a constructions materials provider, so it's very different. For Lee Metal they acquired, they're actually quite similar to Lee Metal, and that's the reason why they acquired Lee Metal in 2016 or 17. Yeah, 2016 or 17 they acquired Lee Metal. The difference back then was that for BRC they focus mainly on private sector contracts, and Lee Metal they focus on government contracts like HDB. So when BRC acquired Lee Metal, they became the dominant player in the market. They now have like say 2/3 of market share in the reinforced steel marketplace. So that gives them a foothold in both the private sector, which they were strong in, and also the public sector. Yeah, so thanks for the question. I think that's all from me. I'll hand over the time to the rest of my team.
I think I can take this question by June. Hi, what is your view on healthcare sector? Ticker XLV and Starbucks. So I think I'll start with the Starbucks counter first. Their stock price has been getting smashed pretty badly, and I think one of the reasons is because of inflation, one, a a tighter, labor market, and so I think margins have been decreasing earlier. So they didn't put out a very good set of guidance for revenue guidance for the quarter. So there are a lot of these kind of downward pressures on their margins that have been kind of over the last 6 to 12 months. And at the same time, I think store openings haven't really been taking off. So investors naturally will be quite worried over there. So that's my view on Starbucks. Hopefully, if and when inflation eases oh, sorry, they also were kind of subject to a lot of movement restrictions in China because they've got a lot of stores in China and globally as well, just due to the pandemic. So hopefully, as things open up and when inflation starts coming down and a lot of these supply chain labor market issues start to reduce, then we'll see a little bit more of some more sunny skies for Starbucks. In terms of healthcare sector, XLV, since the pandemic, I think since the lows of the pandemic, they were up about 60% up to June of last year, and then up about 90% from the bottom to the top altogether, which is quite a significant rise. One of the reasons for this is because they hold quite a number of stocks like Pfizer and Johnson & Johnson, all these, the companies that really benefited from the pandemic because they made all the drugs, all of the vaccines. So since June of last year, I think they've been relatively flat and range bound. Look at the chart. But as a sector overall, they are still a very defensive sector. They've got a lot of your medtech equipment manufacturers and Thermo Fisher. Their largest holding is UNH, United Healthcare. So you would think that they would definitely outperform the overall market, especially in these kind of uncertain times when there's a lot of risk-off sentiment. I think that's should be all for that question. I'll pass my time on to the rest of my colleagues. Thank you.
I think there's one question about by Michelle regarding if I said that the banks and REITs tend to gain with interest rates rise. I think I would meant to only mention banks. Apologies if I said REITs accidentally. Yeah. Thanks.
I think I'll take the next few questions that are in. Any indicative price for Sam Marine or Keppel Corp O&M new entity Bayberry? No indicative price here. The best bet would be that it will trade close to NAV for this new entity, but we're still early because our expected timeline for completion is for the end of this year. They're still in the midst of getting approvals for regulatory approvals abroad because they operate in many jurisdictions worldwide. So until they get those approvals, and then they need to go to shareholders for approval. So until we reach the conclusion, then no indicative price yet. Yeah, I think that's all for me actually. I give it back to the rest of my team.
Seems like there's a few questions on REITs. Not sure if Natalie is there to answer.
Yeah, hi, thanks, Vivian. Okay, I'll take the question on MNEC. So the question is, can I know what's the latest situation on MNEC, which is Mapletree North Asia Commercial Trust? So for MNEC, the merger has been approved by shareholders, both the MNEC unit holders as well as the MCT unit holders, and that was during the EGM held on the 23rd of May. So as of 1st of June, MNEC has received the approval in principle from SGX for the delisting of MNEC. So for those of you who are still unit holders of MNEC, the last day of, or rather the expected last day of trading for MNEC is 8th of June. And in terms of the cleanup dividends for MNEC, that will be announced on the 10th of June. So meaning to say, right, if you were to sell your units before 8th of June, you are actually not entitled to the MNEC cleanup dividends. So it's only if you held it all the way, it means after MNEC is delisted, past the 8th of June, all the way to the 10th of June, then you'll be entitled the MNEC cleanup dividends. So for those of you who are holding on until the 10th of June, you will have between the 15th to the 29th of June to make your scheme selection, meaning do you want to receive 100% cash for your MNEC units? Do you want to hold cash as well as some scrip, or you want 100% scrip? The default is actually cash. So if you do not make a selection, what you will be getting is cash of 1.19. Yeah. Okay, so I hope that's clear. Yeah. For the next question I'll take is for Tasin. Any latest update for Tasin? So if those of you who have been following Tasin, you will know that there has been actually a MOU, or rather it's a non-binding MOU, Memorandum of Understanding, for the sale of two of their assets, which is Siqi Metro Mall as well as Xiaolan Metro Mall. There has been no conclusion on this yet. It's still under discussion. It's non-binding in nature. And with regard to their loan facilities that are actually up for refinancing, there has also been no conclusion, and they're still in talks for renegotiation. However, during the AGM, the board, or rather the chairman, did sort of elect to have or propose the issuance of units or granting of instruments that can be converted into units. So our understanding of this is that they are trying to find contingency plans of how they can, if in the event that they are unable to actually refinance the loans, they could potentially raise some units. That means equity fundraising to come up with the cash to repay the loans, or perhaps convertible bonds. Yeah, to raise the loans that may eventually be converted into units. Yeah. Okay, so I hope that answers the question. Okay, I think another question here. It seems that property developer prices are holding up better than the REIT sector. Isn't both sectors company leveraged and affected by interest rate increase? If yes, why would the property developer share price perform better than the REIT sector? Okay, so for property developers, I think some of them they are still currently benefiting from the rise in home prices, or rather, especially new home sale prices. That is one of the tailwinds that's helping the property developer sector. Not to mention, a lot of them do hold investment property, be it in the commercial assets such as your retail office. Some of them are also holding, or they do have sizable exposure to the hospitality sector, which, as we know, is steadily recovering. So, and while yes, they are leveraged as well, property developers. In terms of the, I think that the tailwinds are actually surpassing or offsetting the headwinds that are coming from the rising of interest rates. Yeah. So for the REIT sector, I think you know, a lot of investors view them as yield instruments or dividend instruments, and as such, the rising interest rates, be it the short-term rates or the long-term 10-year bond rates, that would affect not only the profitability or rather the DPU in a sense, it will also affect the dividend yield spread. The dividend yield spread is actually the dividend minus the 10-year bond yield. So from that, if you're looking at the dividend yield spread as a metric, that would actually mean that in a rising interest rate environment, the bonds, or rather the REITs will look less attractive, yeah, because of when you minus a higher 10-year bond rate. So in general, our view is that the reason why the property developers are holding up better is because of, you know, the recovery of not only their investment property, which are the assets held on book, but also the high prices coming from the new home sales. Yeah. Okay, I think there's another question on SPH REIT. Yeah, I'll take the question later, perhaps. I think most of the questions are for me. Please give me a minute. Hi. Okay, sorry. So I'll talk about the privatization of Fraser's Hospitality. Okay, so the privatization price of 70 cents is actually you know, it actually implies a price to NAV of 1.07. And of course, I think that comparatively, if you look at how the hospitality REITs have traded, the price to NAV ranges between 0.9 to 1 times, or sometimes even 0.8 to 1 times price to NAV. So I think we would say that for this privatization deal, it seems like it is a good deal, although that just means that the unit holders might not be able to benefit from the further recovery of the hospitality sector. But overall, yeah. Yeah, so I think overall it's still a relatively fair, if not attractive deal. Yeah. Another question here is related to Fraser's Hospitality as well. Would the privatization of Fraser's Hospitality Trust be positive for other hospitality REITs like Far East Hospitality Trust? In a way, yes, because the privatization value is approximately is above the price to NAV, which as I mentioned earlier, no, hospitality REITs have always been trading at a discount to price to NAV. So that of course would be a positive. The real question is how much more of a premium can be extracted? Can it go to 1.1 times, 1.2 times? I think that really depends on the portfolio of the respective REITs. Yeah. Okay. Another question here is, what are the signs that we can look out for to signal the turnaround of the REIT sector prices? As for now, while the interest rates have been rising, and I think we still look to the Fed to see how many more price increases, or the magnitude of the price increases. So I think we have it will still take a couple more months before the situation with the Russian-Ukraine, as well as the stabilization of the interest rates, or more clarity on the interest rates. So I think it will take a few more months before we can positively or more confidently say that the turnaround of the REIT sector is in view. Okay. Okay, so there's another question, follow-up question regarding Fraser's Hospitality REIT going private. So, and the reasons behind it, I think the reasons cited by their sponsor, Fraser's Property, as well as the REIT itself, the reason cited was because of poor market conditions and challenges faced by the hospitality group, during the pandemic. So that was the main reason cited by the sponsor. Okay. Okay, for the drop in Suntec price, unfortunately, we don't really know of any reason why the share price dropped. Okay, so sorry, we won't be able to answer that very well. Okay, there's another question that just came in. The latest on the US REITs, which I believe are Manulife US REIT, Prime US REIT, as well as Keppel Pacific Oak. Okay, I think most of them are still they're still working on the backfilling of their occupancies, as well as we actually do expect some rental growth coming from the REITs. The REIT that we feel that is particularly more challenged would be Manulife, but I think in terms of the remaining two, which is Core, Keppel Pacific Oak, as well as Prime US REIT, we're more confident of the recovery in the rental growth in their respective markets, as they have more exposure to the growth markets. I believe the rest of the questions are more for Paul, who is unfortunately not in this session with us, as he has taken some time off. Okay, so I think with that we can end the session.
Yeah, thanks, Matt. Thanks everyone else for joining us today for our weekly market call. I look forward to seeing you next week. Bye. Also, you can check out the recording that should be posted on YouTube within a couple of days.